Today, we're diving into one of the hottest debates in the world of investing, stocks versus cryptocurrency. With so many people looking to grow their wealth, the question of which is safer often comes up. Both options have their passionate supporters and unique risks. In this video, we'll break down the differences, compare the risks, and help you understand which might be the safer choice for your financial goals. Let's start by understanding what stocks and crypto actually are before we dig into their safety profiles. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that business. Stocks have been around for centuries and are traded on regulated exchanges like the New York Stock Exchange. They're backed by real companies with assets, products, and employees. Investors often choose stocks for their potential to grow in value over time and for the possibility of earning dividends. But like any investment, stocks come with their own risks, which we'll discuss soon. Cryptocurrency, or crypto for short, is a digital form of money that uses cryptography for security. Unlike stocks, crypto isn't tied to a company or physical asset. The most famous example is Bitcoin, but there are thousands of different cryptocurrencies out there. Crypto is traded on digital exchanges and can be sent or received almost instantly, anywhere in the world. While it offers exciting possibilities, it's also known for its wild price swings and lack of regulation. One of the biggest differences between stocks and crypto is regulation. Stocks are heavily regulated by government agencies, which means there are rules in place to protect investors. Companies must provide regular reports and follow strict guidelines. Crypto, on the other hand, operates in a much less regulated environment. This can make it riskier, as there's less oversight and fewer protections if something goes wrong. Volatility refers to how much the price of an asset goes up and down. Stocks can be volatile, especially in uncertain times, but crypto is known for its extreme price swings. It's not uncommon for a cryptocurrency to rise or fall by double digits in a single day. This can mean big gains, but also big losses. If you're someone who prefers stability, this is an important factor to consider. Looking at history, stocks have a long track record. Over decades, they've generally increased in value, despite short-term ups and downs. Many people use stocks to build wealth for retirement or major life goals. Crypto, on the other hand, is much newer. While some coins have seen explosive growth, others have crashed or disappeared entirely. The lack of a long history makes it harder to predict how crypto will perform in the future. Security is a major concern for any investor. Stocks are held in brokerage accounts, which are usually insured and protected by law. Crypto, however, is stored in digital wallets. If you lose your password or your wallet is hacked, your funds could be gone forever. There's no central authority to help recover lost crypto, making security a bigger issue for digital assets. Liquidity means how easily you can buy or sell an asset. Stocks are very liquid, especially those of large companies. You can usually sell your shares quickly at a fair price. Crypto can also be liquid, but smaller coins may be harder to sell, especially during market crashes. This can make it tough to get your money out when you need it most. Market manipulation happens when individuals or groups artificially influence the price of an asset. Stocks are monitored for manipulation, and regulators can step in if they spot illegal activity. Crypto markets, however, are more vulnerable to manipulation due to their lack of oversight. This can lead to sudden price spikes or crashes, adding another layer of risk for investors. Both stocks and crypto offer the potential for returns, but the nature of those returns is different. Stocks tend to grow steadily over time, and some pay dividends. Crypto can offer huge gains in a short period, but those gains come with high risk. It's important to balance your desire for returns with your ability to handle losses. Getting started with stocks or crypto is easier than ever. Stocks can be bought through traditional brokers or online apps. Crypto requires setting up a digital wallet and using a crypto exchange. While both are accessible, crypto may have a steeper learning curve for beginners, especially when it comes to keeping your assets safe. Diversification means spreading your investments across different assets to reduce risk. Stocks make it easy to diversify by investing in different companies or sectors. Crypto is less diverse, with most coins moving in the same direction. Relying too much on one asset class can increase your risk, so diversification is a key part of a safer investment strategy. Investing can be emotional, especially when prices swing wildly. Stocks can be stressful, but crypto's extreme volatility can lead to panic buying or selling. Staying calm and sticking to your plan is important, no matter which asset you choose. Understanding your own risk tolerance can help you avoid making decisions based on fear or greed. So which is safer, stocks or crypto? For most people, stocks are considered the safer option due to their long history, regulation, and investor protections. Crypto offers exciting opportunities but comes with higher risks and less oversight. The right choice depends on your goals, risk tolerance, and how much you're willing to learn about each market. In the end, both stocks and crypto have their place in the world of investing. Stocks offer stability and a proven track record, while crypto brings innovation and the potential for high returns. The key is to do your research, understand the risks, and invest only what you can afford to lose. By making informed decisions, you can find the right balance for your financial future.